My name is Ben Jarinas. I am a real estate investor in New Jersey. Last 10 years, well, 12 years at this point, I've done upwards of 50 projects in different capacity, right? Sometimes as a flipper, I've held some. I've yet to do ground up. That's the one thing I haven't done. But this last project, I spent 800 grand renovating it, so it might as well have been ground up. So I guess we can start. Sorry, I'm not controlling it. Perfect. All right. So quickly, again, this is meant to be very high level, new for new real estate investors, realtors looking to expand their expertise, and mortgage professionals. I'm not going to go too deep into the concepts and the tricks and of the trades that I have, but I'll definitely cover some and go over some of my experiences. Okay. All right. So again, ground rules for me, it's going to be education first. That's how I try to train, right? Really kind of talk about what I've gone through as an experience. I'm a big proponent and believer of don't need to reinvent the wheel. Just align yourself with someone who has and learn from them, even if it's at a cost, right? My focus is going to be on real world, not theoretical, not what coulda, shoulda happened, more around experiences I've had myself as an investor. And lastly, towards the end of this, if you guys want to get started, Next Mortgage will be your best point of contact on this. I work with them directly. Happy to, continue to guide you on that path and help you guys succeed. Okay. So in real estate investing, there are different, the main ones that I want to address today will be, again, fix and flip. You guys have heard of it. Buy a house, fix it, and sell it, right? The BRRRR method, which is, it's not a new concept. It just has a new name, right? It's to buy, rehab, rent, refinance, repeat. That's the way, if you want to build ultimate wealth, that's the path. All right. The bridge product, it is funny enough, it's a confusing product for most people, but it is a very effective product. All right. And the last piece, obviously, ground up, new construction, which you guys are pretty familiar with. That is the one that gives you the highest and best use and the highest return, but also comes with the highest risk. The biggest thing I did when I started, I focused on my why. Right? And I would say that's like step one in doing this, just like with anything else. Why are you doing it? It can't just be because, I want to buy something benign, right? It is a commitment if you want to be successful. Okay. Moving on to the four strategies, the four main ways investors make money. And I'm saying four because I feel I'm a strong believer in real estate investing, specifically in real estate. There's 1,001 ways to make money. You could be a realtor, you could be a wholesaler, you could be a lender, you could be, fix and flipper, you could be, a land buyer. There's contracts. There's 1,001 ways to make money. But these are the four main ones that any investors, regardless of where you're from and your knowledge base, can start with. All right. Not the fix and flip strategy. Again, buying, distress, renovate, and sell for profit. It's the most popular one, right? It's been popularized by HGTV. You're buying something below market. You have to have good, accurate estimation of the rehab. You have to manage the contractors, otherwise they'll manage you, right? And they'll manage the project, which you at someone else's mercy. And the exit has to be clean, right? So you got to know this is what I'm selling it for. This is the estimated profit on the back end. All that stuff on the front end that makes your profit more or less guaranteed on the back end, right? Okay, so right here is the investor formula, right? So what I personally use, and I stick to it to this day, even though it's harder and harder to find deals that fit that mold. But because I do this, and I joke that if I don't feel like I'm stealing the house, I'm not interested. And the reason for that is it's got to absorb everything that will go wrong. It's Murphy's Law when it fix and flipping. You start rehabbing. From that sense, ground up is actually easier, all right? You start rehabbing. No matter how many times you have an inspector go through the house, they'll never find everything. Right? These costs add up quickly, right? So a lot of the times what I end up doing is I'll stick to this formula. 70% of future value, ARV, minus the cost to repair it. That's my ideal purchase price. Here's an example of how that formula works. Right? So if let's say you're in the market where single family house is selling for $500,000, $500,000, and the cost to fix it is $100,000. 70% of 500 is 350. My okay, minus the cost to repair it, 100,000, your max purchase price should be about 250. Okay, that right there tells you within that purchase price, if let's say right between 350 and 500, okay, you have enough cushion now to absorb interest costs, taxes, insurance, cost overrun, selling costs. Even if you guys are realtors, do not count your realtor fee as profit. It is not. It is two different jobs. Two different jobs. 5, 6, whatever it is you're charging doesn't matter. It is two different jobs. You have to keep them separately. Okay. But then that extra 30% between 70 and 100, obviously, that 30% spread covers everything. My general rule of thumb when I'm doing a flip is I'd like to make 20% of the sales price as my net profit. Now, the next strategy is the BRRRR method I've talked about earlier, where essentially you're buying, you're rehabbing, you're renting out, you're refinancing, you're repeating. As I said earlier, this is how investors really build wealth. You can pull your capital out, do refinancing, hold the property long term, scale your portfolio that way. And that's actually, in my personal opinion, it's the best way for landlords to make money. Case in point, I have a property I bought from online auction. Turns out I was the only one bidding. I ended up picking up the property for $272,000 and did close to $500,000 of renovation in there. It took me 4 years paying double-digit interest on the money. All right. At one point in time, I thought this is not going to work out. I'm probably going to have to take a bath on that one and move on. But COVID, really changed the course for me. And now the property's probably worth close to $1.5 million. All right. But because I bought it right, I did the renovation. All right. I have such a low cost basis that my income on it obviously is much higher because my mortgage is next to nothing. And I'm actually using it right now. It's a 2-family, 2 units where one unit's my personal use because it's right by the beach. And the upstairs is what an Airbnb. And I think last year we made like 90. Right? So this is if you can really make your money with the BRRRR method because, again, one, everything that's wrong with this house, all right, because you renovated it yourself. And 2, you have lower cost basis because you bought it right. So that's a great one. The SCR, which is the rental product that I'll let Kristen and Amber kind of speak on, but that one is the one that basically correlates directly with the BRRRR method.
So yeah, this is the product that so the fix and flip and everything would be something that I would get Ben's help with, but our DSCR product is a fantastic way, whether not really for the fix and flip side, but for the buy and hold. When we're reviewing this product with you, we're strictly looking at what the rental income is going to be. We have no ratio loans where there doesn't have to be a minimum amount of rental income to qualify. And then we have other products that allow you to have a 75% or a 1% debt coverage ratio. These products typically are 20% down, but we don't look at your tax returns, your W-2s, your other debts, your other incomes. We're strictly just looking at what the rent is and looking to see how that's going to offset with the mortgage payment. It works for short-term and long-term rentals. So we can look at what the rental income would be on a short-term basis, just because there's a lot of that also in a lot of different markets, and then also can be long-term. And it's really meant for any real estate investor. We have programs that allow for you to be a first-time investor as well. Sometimes that can be a little different qualifications. And it allows for even, somebody who's maybe self-employed or doesn't necessarily qualify with their income to qualify.
So yeah, as I mentioned, the Investor Bridge, it's meant to be, it is not a construction product. It is a bridge to something else, right? Thus the name. So I like to joke that this product is really a home for like misfit loans, right? You have a situation where you need to bridge or, the property needs to be rented, right? You did the renovation, your loan came due, you have to refinance. You refinance out into a bridge loan, right? You can even do cash out on those too, usually up to 65% of value, all right? You cash out, you refinance while you stabilize the property, get it rented, get it cash flowing before you go back into a long-term debt, right? Or you need to get plans and permits before you start the work. Or, just like I mentioned before, my situation is it's arbitrage, right? You get a really good deal, you don't need construction, you get a bridge, You sell it and you make a profit. Ground up construction, as I mentioned before, it is the one that gives you the most value, right? Because you're taking a piece of dirt, creating something brand new, but it's also the one that has the steepest hill to climb. What I mean by that is most lenders will want you to have experience. They'll want you to have done this before. You got to show enough liquidity in the bank. You have a good crew that's working with you that can manage the project. So a lot of times it's not the strategy I'd recommend for someone brand new unless you're partnering with a builder, right? But outside of that, it's a great strategy. I've yet to do one myself personally, just because I just, don't want to deal with it. But it is one that a lot of my colleagues are getting into. As a matter of fact, I have this kid, and I call him a kid because when I met him, he was 17 when he started. He runs he does about, I think, like 20 to 25 ground up projects a year. Very aggressive. He's got a whole team, he's got design, and it's to a point right now where his houses resell because people are expecting the new stock every time. Right. So it's a great strategy. You can make a ton of money doing it, but again, comes with the skill requirement. Okay. Now this is where we kind of discuss the different deal sources. Obviously the most popular one is the MLS, working with wholesalers in your market, right? Going through meetups and online and Facebook groups. There's tons of wholesalers. Now the downside to it is wholesalers, a lot of them would be, taking an online course and start getting into the project. And a lot of them I found would overbid on the properties, and they will way underestimate the rehab budget. So their numbers would never work, but they are good ones out there and you got to find them. The other one obviously is direct marketing, mailers, cold call, door knocking, Facebook ads, social media ads. These are all great ways, but you have to have the bandwidth to manage the flow there. And last but not least, last two would be referrals, right? Your referral network is where you'll find the best deals. They're not going to be a crazy flow, but we'll find the best deals that way. Telling everyone that will hear you that you're a real estate investor, even if you're not, fake it till you make it. Attorneys, CPAs, real estate agents, other sellers you've had experiences with in the past, right? These are all great deal sources, right? And these are usually the best ones because they're calling you, they're only dealing with you, you don't have any competition. And lastly would be investor-friendly agents. If you tell them this is what I do, and usually the way I would work with agents is if you find me a deal and I buy it from you, you get the listing on the back end. Guaranteed. So even though at the time I had my real estate license, I got rid of it since, but usually that's how I would get a good flow from realtors, knowing that they get the listing on the back end from me guaranteed at like 5%. So I wouldn't have to chase stuff, and they bring me opportunities that way. Usually get into what I've mentioned before, the deal analysis. That's the first step before you do anything else. Understanding what, obviously, maybe you know what the purchase price is, estimate the rehab, divide that by the ARV, that'll give you the basis. As I said before, anything between 65 and 70, that's a deal all day, twice on Sunday, take it and run. Under 65, oh my God, you're still in the house, right? And you will get lucky like this once or twice. But anything above 75, I would be very, very cautious on. Okay. As I mentioned before, your profit's made when you buy, not when you sell. All right. So this is the process. So you'd find a deal. You work with your team for the pre-close, whether it's your title, your attorney, your lender, and everything else, right? Then you go for the execution, which is working with the contractor, working with your vendors, right? If you're doing a fancy project and you need, specialized material. And towards the end, you work with your realtor with the exit, right? Make sure they stage the project. Make sure they basically put your property, especially if you're in a competitive market, that your property is best placed to get the best value on the back end. All that stuff is part of the investor process, and you have to have a team along the way to actually help you execute on something like this. The contractors, my personal opinion, they make or break your deal. All right. If you don't manage them, they manage the deal, and you don't want that to happen, right? Because their incentives, their motivation is not aligned with yours. Okay. Good contractor management. Basically, you've got to give them a detailed scope of work. You can't rely on them to tell you what to do, right? That's why getting your inspection done yourself, separate the entities. They can't be related because you don't want them to start colluding against you, right? Even if it's unintentional, it's going to happen, right? Especially when it comes to money. The draw schedule tied to milestones, not dates. What I mean by that is every time you complete this, that's when you get paid again. That's when you get paid again. So this way, they're not going to rush to complete certain items and do it wrong, right? Just to get paid. Then you find out, like I had a project once where I trusted the contractor too much, and he finished the house. I sold it, and 3 months later, I'm getting a call from the seller saying, why is the bathroom leaking? It turns out he told me he did the work, and I wasn't checking because, again, I had a lot going on other projects, and I trusted him, and he charged me for new plumbing material, but he used the old ones that were leaking. But then, and 3 months later, found out the whole ceiling was covered with mold because it had been leaking this whole time. All right. Weekly site visits, take pictures. All right. I have folders and folders in my drive of all the job sites I've gone through and taken pictures. And it serves two purposes, obviously, so you can remember, especially as you start doing more and more projects, you don't know what's what. And two, it serves for your brag book too, right? Because you can then use that towards marketing material. Okay. Underwriting. Next slide. All right. So the investors that are the most successful in this business are the ones who think like lenders. What I mean by that is you got to approach your deal. It's not about how much money you're going to make, how good the deal is. It's about how would a lender approach it, right? Because there are different types of lenders in the space. Obviously, there are the institutional lenders. They charge more, like closer to what a bank would charge, right? But much higher, but closer, like you could be single digits, right? Interest versus you have private money, which are like the private lenders, hard money, if you want to call it that. They'll charge double digit interest, but they won't care about anything. All right. So it all depends on the kind of financing you're looking for. But the one thing I will add to that is if the profitability of your deal is rooted in getting the cheapest financing, you don't have a deal. When I started, I used to pay 15% and 5 points. All right. And I still made money, but that's what was available at the time. All right. Now the market has changed drastically. You know, Wall Street's all over this space. So there's access to cheaper capital, but it still comes at a steeper underwriting process, right? They care about credit. They care about experience. They care about liquidity, how good of a deal you have. That usually comes in last, all right? That's how they think. So if you can think like they do, you have a much higher chance of getting every one of your deals financed. So the 4 pillars of underwriting, obviously, it's the deal. Are you going to make any money? If you're not going to make any money, then why are you doing this? Because remember, this is a business purpose investment loan, right? So if your goal is to, I want to fix this house and sell it and maybe I'll make money, the lender is not going to say no. Again, like I said, no one's going to slap a gift horse in the mouth, but you're going to pay for it, meaning putting 20, 30, even 40% down just to get the money to buy the place and fix it up and sell it and maybe make money, right? The lender's not a partner. They're more a facilitator. They'll help you achieve your goal, but they're not going to take the risk with you. Okay? So they underwrite accordingly. The borrower, who's executing? What's the track record? What's their credit profile? Experience level? Do they have anything in their background, right? These are all the things that the lenders care about, and that affects their underwriting and their pricing accordingly, right? Liquidity. How much money you got in the bank? Do you have enough reserves to handle overruns, delay, and carrying costs? Once a loan's issued with a rehab budget, and if you need an extra 15, 20, 30 grand to fix the project, they're not giving that to you, coming out of your pocket. All right, so do you have enough liquidity to support that, especially if you're new? All right, and the last piece, the exit. How are you getting out of this? How am I getting my money back? How is the lender getting repaid? Is it through a sale? And do you have enough profit margin to cover all the costs you've incurred plus paying them back? All right, utilizing those 4, if you understand it from their viewpoint, you'll see why they'll say yes and no accordingly. Last piece here, I guess, before we almost wrap up here, we can switch the slide. Yeah, so really it's all about understanding why deals get declined, right? A weak borrower and a weak deal is not going to work out. A weak borrower and a good deal might work out. A good deal and a good borrower definitely works out, right? Liquidity comes into play, but if you have a really good deal, they may make some exceptions because of it, all right? So there's different ways you have to look at it. Now, the 4 most common reasons why a deal gets declined, obviously tight margin, how much money you're going to make. If it's not really profitable, why are you doing this? A weak borrower profile, like, poor credit, no experience, no track record, you can't make up for it in any other way, right? And at that point, you need a partner. No liquidity, you don't have enough reserves, to support any, oh snap moments during the project, and you don't have a clear exit. So, oh, maybe I'm thinking about selling, I'm thinking about refinancing, maybe bridging, and I don't know. Like, why are we doing this? So if you're understanding all these things, that makes it a lot easier to get approved and a lot easier to get your project going.